Have you ever looked at your gross income and then the actual amount you pay in taxes and wondered how those numbers add up? It can feel a bit like solving a puzzle, figuring out the true cost of taxation beyond the initial percentages. The effective tax rate is determined by dividing the total tax paid by the total taxable income, representing the actual percentage of income an individual or company pays in taxes after all deductions and credits are applied. This figure often differs significantly from the statutory or marginal tax rates initially presented. The primary reason for this difference lies in the progressive nature of many income tax systems and the various provisions designed to reduce tax liability. Most state and federal tax codes are structured with multiple income brackets, each subject to a different marginal tax rate. As your income increases, only the portion of your income that falls into a higher bracket is taxed at that higher rate. This means your entire income is not taxed at the highest rate you reach. Furthermore, the availability of tax deductions, which reduce your taxable income, and tax credits, which directly reduce the amount of tax you owe, play a substantial role. These mechanisms are put in place to encourage certain behaviors, support specific groups, or alleviate financial burdens. To understand your own effective tax rate, it is essential to first identify your gross income, which is all the money you earn before any taxes or deductions. Next, you will account for various allowable deductions, such as contributions to a traditional individual retirement account, IRA, student loan interest, or certain itemized deductions like mortgage interest. These deductions lower your adjusted gross income, the GI, which is the amount of income subject to tax. Finally, you will apply any tax credits, such as the child tax credit or earned income tax credit, which directly reduce your taxable dollar for dollar. Calculating your total tax paid and then dividing it by your total taxable income, not your gross income, will yield your personal effective tax rate. An interesting nuance in tax policy is the concept of tax incidence, which refers to who actually bears the burden of a tax, not just who initially pays it. For instance, while a corporation pays corporate income tax, some of that cost might be passed on to consumers through higher prices, to employees through lower wages, or to shareholders through reduced dividends. This concept highlights that the true economic impact of a tax can spread beyond the entity legally responsible for paying it. Understanding your effective tax rate empowers you to see the real financial impact of taxes on your earnings. It provides a clearer picture than just looking at marginal rates alone, allowing you to make more informed decisions about financial planning and recognize the full effect of tax policy on your personal or business finances.